Ooh, love my intro.
Yeah, hard rocking.
Welcome to Freight Forecasting. I'm Michael Vincent, freight forecaster here at FreightWaves. Beside me, I've got Zach Strickland, Director of Freight Market Intelligence. Is that correct?
Yes, sir, it is.
And our guest today is Mr. Kyle Lintner of K-Ratio, I believe, Principal and Managing Partner. Is that correct, Kyle?
That is correct.
Excellent. So thanks for joining me again, Kyle. Kyle's starting to become a regular on here. He posts some really, really good stuff, and that's kind of what I want to dive into today, Kyle, is everybody's watching the volumes in the freight market, et cetera, and watching how it's kind of reacting very seasonally right now. Really, if you look at the year over year, you can almost predict what's going to happen over the next couple days or week. It would appear at this particular moment, but how long is that really going to last? Because that's you're fooling yourself if we're in the same economy or a better economy than 2018. Correct?
I fully agree. Yeah, that's the golden question that we're all trying to answer: is how long does this last?
Yeah, it's crazy, and so you've been doing these weekly things out on LinkedIn, giving these. I guess it's the week ahead or something like that. You call it. I forget. I don't pay attention to the name, but the content is excellent.
The week in preview, Mike.
The week in preview. That's what it is. That's what it is. I need a what do I need? A thesaurus.
Yeah.
That's what those are. But. So you were going through it. You were going through the current state of what's going on, of what we're seeing happening right now. So you could set up kind of this. You were talking about imports and maybe where things were going to go. But the title was along the lines of "Get ready, folks! It's going to get busy." Right.
Right.
So I've got Sonar pulled up here, and I've got Zach with us, so we can have this discussion and really kind of go through this. You want to go through like a couple of those charts? I have them pulled up here, and we'll kind of talk to that to set the stage and talk about this.
Yeah, sure. Let's do it.
Excellent. So, Cody, if you'll bring up my screen for everybody to see. So, Kyle, go ahead. You can kind of talk to a little bit about what you were talking about on your the weekend preview.
Sure. So what I went through in the last video is basically what I do every time that I go onto Sonar. I have usually the same general pattern of progression on how I look at things to try and figure out not only what's going on today, but then the ultimate question of what's going to happen tomorrow and the day after. And specific to the video, what I was getting at, in the same vein of how I always do it, like I said, I start with the OTVI. I always want to see how much volume is going through the market at one time because as with any really financial market, volume vindicates price. So let's first figure out how much we have going through the system. And when I took a look at the OTVI, as has been the trend recently, that considerably strong volume. And if you pull it up like you have here on a seasonality where we can look at year over year, because comparables are always going to be what's important, we want to be able to make those comparisons between what we've known in the past and what we believe to be happening tomorrow and today. We can see that this strength we're seeing now is beyond typical seasonality. And if you look at 19 and then 18, obviously those 2 years are really the tale of two different freight markets, one being extremely bullish on rates and one being extremely bearish. And you see the volume for 2020 exceeds obviously 19, but also 18. And that's when the questions start to come up and people wonder, well, if the volumes are so much higher than what we're seeing even in 2018, the record bull year, why hasn't price followed along with it? And that's when we start to go down the path of trying to figure that out by taking a look at some of the other data. So, the next stop for me, typically once I look past volume, is then the rejections, because OTRIs are not always clearly indicative of price, but it definitely is the greatest impact on it, and it starts to head you in the right direction for it. So again, here if we look at year over year for 2019 and 18, we can see the OTRI, we see the huge jump, late May, early April from the restocking pull forward from coronavirus. But we see an OTRI number nationally that looks a lot like 2019 than it did to 2018. So that right there can tell us why we see price right now not quite to where it is in 2018's levels, but price from a national standpoint is way higher than it was in 19, yet we see the rejection somewhat lower. So then to me, that means we have generally the same amount of available capacity, but it's unequally distributed. So that's when I begin to try and figure out, is there a region or maybe a primary driving market behind what's creating this miniature disruption, if you want to call it that, inside of the freight market.
Before you do that, Kyle, I want to jump in real quick. I think you make a really solid statement, because I get this question an awful lot about why the volume and tender rejections are somewhat disconnected. We've talked about it a lot in our in our shows. But I think, tender rejections are, of course, the end result of supply and demand in the freight market. Right. And, coming out of, you have to provide context. And I know that 2018 is still relatively fresh on a lot of people's minds. But considering the amount of, volume and inflation and rates that we saw in 2018, leading to the massive influx of capacity that we saw that, really buried the rates in 2019. Something that I tell people traditionally is, you have to look at the previous year to see what this current year's scenario is going to be, or what it's, some of those factors that are influencing it. And knowing that we had a huge amount of people entering the market, they were buying trucks like crazy in 2018. They got on the road in 2019. So really what we're seeing, the difference here is, the net impact of seeing the supply come in from 2018 into 2019. So the oversupplied 2019 market, but it's combined with the volumes of a 2018. So the net impact of those, you can just see how clearly oversupplied the market is almost by looking at the variance between that 24% in 2018 and the 7% in 2019. So building off of 2019, you can kind of assume that it's going to take a while for us to have any real, large-scale impact to that rate barrier, that threshold.
You're gonna have to lose. You're gonna have to drop capacity.
Yeah, you have to drop capacity, and we're not seeing. That doesn't happen overnight.
No, it absolutely doesn't. But there's some danger signals that are out there. And Kyle, I'm sure you've heard this as well. When Kingston came out with the Bank of Montreal numbers with the loans to small and mid-sized fleets, record number or 40% up year over year in defaults. And then, or write-offs, and also in impaired, or which they call, they're in critical condition where they're probably going to fail. And those are 75% of those loans, 80% of those loans are small to mid-sized fleets in the United States. So still the outlook not really good, even with these volumes. And I guess that would be depressed rates, right?
Right. And then if you just think about what's happening in reality, it's almost like we're just kicking the can down the road with the capacity bleed off. Everyone's trying to hold the breath a little bit longer underwater and say, I'll wait for the turnaround or wait for the turnaround, and you just keep waiting and waiting. Some of this is diffused by the fact that automotive obviously isn't what it used to be, and there's some other industry sectors that don't quite have the volumes that we used to. But who's to say those are going to come back at anywhere near the capacity that they were before? So if that's not the case, this bleed off, even though we're kind of prolonging it, at some point we're going to go into full default. And I've made my argument several times. Anyone that follows me knows that I don't think capacity ever truly leaves the network. It's just shuffled from ownership from one entity to the next. But we're going to have that moment where we suddenly realize there is not enough capacity. There aren't enough carriers to haul the demand that's out there. And at that point, that's when we get that big rally in mass across all lanes as far as freight rates are concerned.
Yeah, I agree. And I think part of that problem, and that's what we were talking about, it was the mini bids or micro bids.
Right.
Yeah. we were talking about, right? Because shippers want these low rates, right? But I think they're realizing in talking to the carriers, and the carriers, or maybe the carriers are realizing that both sides are realizing that locking in or pulling forward an annual bid right now is not the smartest move in the world for either side, even though rates are low, right?
We are just stuffing more kindling wood into that fire, man. And when it goes, it's going to go.
Yeah, you're tossing stuff. Zach, did you have an input on that? Or?
Yeah, I mean, it's one of those things. We can't really tell what the demand's going to look like in the third and fourth quarter, but the potential for it being very rough at some point down the road is really high, considering the amount of fluctuation we've seen in both volumes and, the capacity side. And a lot of these carriers were already on the ropes at the end of 2019.
They were, and then they got propped up by PPP.
Yeah, and so COVID almost has extended their life cycle a little bit further, and come August, if they can't pull it together, and again they're not getting the same upward pressure on rates that they had in 2018 to keep them in play. They're still they're getting the 2019 rates that they were struggling with.
Well, and also once you've incurred a certain amount of debt and there's not enough influx of cash or upward pressure on rate that can save you at a certain point, right? You've gone over the brink.
Yeah, and these lulls in volume are detrimental to a carrier. I mean, they're tremendously I mean, it doesn't matter how much loan you pump in there. If you were parking your trucks during a time of year with a 98, 99 OR, you're not going to make it much longer.
not good. Not good.
But so, Zach, that's a great point, and those are part of the things that get overlooked. If you're a carrier out there, the only thing that's been saving you the past year plus has been elevated contract rates. And unfortunately, your truck's not running contract loads all the time. At some point, every major carrier has to go into the spot market just to get his truck repositioned where it needs to be. So if we see spot rates decline and stay depressed for too long, and then we see the volumes come to match it, well, now that blended average rate for a carrier begins to come down. And that's when you see the insolvencies. They just can't run profitably because you can't expect a truck to run a contract load every single time. And then it doesn't help, the cherry on top is the mini bids that you mentioned, because now that carrier is repricing their contract rates lower and lower and lower, and the spread between the two begins to narrow, and now we effectively have just one rate out there. And that rate for many carriers out there is not sustainable because it just isn't something that you can profitably run your business at.
Excellent points. Excellent points. Hey, Kyle, you were going towards, I believe, the map that I have now displayed. If Cody, you could bring that up for everybody to see. Kyle, I believe you're going to go into what you call the domino effect.
Yeah, what I was getting at was that for the past couple of weeks, I had highlighted how LA turned very hot, and that became the market to be in if you were a carrier. We saw higher volumes and then obviously higher spot rates as capacity wasn't there. So, the argument that I was making is that price serves as an advertising instrument, and all it does is tell people we need more capacity in the area. So as price rallies, the carriers see that, and then they obviously head to the area. What happens next is how the domino effect starts. The easiest way for us to reconcile a deficiency in capacity in a particular market is to take capacity from the nearby markets that are closest. So we see the nearby markets, anywhere between 200, 300, 400 miles, something that can either choose to deadhead out to LA or maybe pick up a quick load at a depressed rate because they know they're going to get that juicier rate coming out of LA. What happens then is it creates a vacuum in capacity for those other areas. So once every carrier in the region heads to LA, we obviously see LA then pull back as far as rates are concerned. And in its wake is every other market that now lost capacity to LA, and they become the markets that see the elevated rates. So LA begins as almost like an epicenter of the movement, and then it moves throughout the country. How far that goes is dependent on how long the increase in volume can sustain itself. And I think that's what we're all trying to wrap our heads around right now is this jump in volume somewhat of a temporary restocking or a temporary shuffling of goods post somewhat COVID quarantine ends, or is this signs of things returning to normal? Everybody has a different opinion on that, but the answer to that question, I think, ultimately decides what happens to the freight economy for the rest of the year.
Yeah, agreed. And that is the ultimate question that everybody has. But really quickly on this one, I want everybody to know what we're looking at here and understanding this, because as I'm hovering over these different markets, you're seeing things like 3.43%, and you're looking at LA at 1.62%. And that's not the percentage of outbound tender rejections. We're looking at the weekly change. So that's the change in those rejections. You've got this huge volume like you're talking about in Southern California, LA, Ontario, and those rejections are going up, and they're fairly elevated, correct, Zach?
Yeah, they are. They're one of the hottest spots in the country right now due to the fact that LA, like you mentioned, Kyle, LA volumes have been sustained for quite a while, and not just LA volumes in general, because you can have this regional freight movement that doesn't have near the impact to capacity that these long-haul freight movements have. And a lot of what we saw in May was a growth in LA volumes to the long-haul side. Mm-hmm. So it's really difficult. It's one thing to reposition your fleet regionally and operate out west and move between LA, Salt Lake City, San Francisco, Phoenix, etc. It's another thing to drive all the way across the country, 3,000 miles, to Harrisburg or Philadelphia, and then get that truck back into that market. That is that's a long cycle to get that truck all the way back out to LA. So seeing these elevated tender rejection rates, out of LA, they can only last for so long, because especially if the rest of the country is disproportionately inactive, they're not going to be able to get inbound into the West Coast without significant deadhead miles. Right. And carriers will have to adjust their pricing to account for it.
Right.
And Zach, you're 100% right there. And that's something, I alluded to 3 or 4 weeks ago to anyone who's a shipper, because that problem in LA didn't affect you at that point. But like you said, a lot of that freight was going long haul, and the repositioning of a truck just isn't going to happen when you're going 1,000+ miles. So, if you're a shipper and you start to see things like that from a major market, you have to take note, because it might not be your region and it might not be your load. But if that truck is now repositioning itself at such great lengths, he might cancel on you for his next load, or it might be the third load in his triangulation route that gets canceled because he's choosing to do something else. And we can see a little bit of that cancellation stuff on the map there. Mike, you were hinting at it. LA is the epicenter of the problem, but then we see all of that blue in the surrounding areas on the map. And that's because if you're a carrier, your alternative from your dedicated contract route now suddenly is a 50 cent per mile higher rate for a load that might even be longer in duration. Music to the ears of any carrier right now is not just a higher RPM, but keeping the wheels moving for longer. So if you can run a longer load at a higher rate, now you have the best of both worlds. And that's almost like a secondary domino effect of how this can create the beginnings of a market rally across the entire nation, whether the problem isn't a lack of capacity in an area. It's just now we have the disruptions in the freight routing guides, so the carriers aren't where they need to be on their second or third loads across the country.
Yeah, and we're starting to see a lot of that domino effect, as you said, in the middle part of the country. Just this week, actually, down in that blue section you see in the middle there with Kansas City kind of being an epicenter. Now, we traditionally have pretty strong amounts of tender rejection rates here in general, but this week itself, we've actually seen a large increase in the Kansas City, Dallas markets, as a lot of these carriers have been traveling long distances, kind of bypassing their center points and their networks. So this disruption in the middle of the country, because there just has not been the amount of inbound to support the what has been a relatively regular amount of freight volume in these markets. Dallas a little bit heated over 2019, but the disruption's real when we see the tender rejection rates there jumping up pretty significantly here in the middle of the country, where there's, these markets are typically on an island in general, in terms of population and freight volume. But you can see this coming down the road.
So when we're talking, we've talked about, excuse me, Kyle, we've talked about insulated and non-insulated markets before, and you can see that kind of in the reefer capacity when you look at Atlanta, and then when you look at we were, I guess, in the St. Louis area and so on there, Cape Girardeau, that type of area. But it's not necessarily the next door market that's affecting you, right? If you're, like you were saying, Kyle, if you're a shipper, you've got to be looking at all these different things and seeing what's going on, because LA heating up, where is that going, could be affecting you in the center of the country as to, like you said, that triangulation of loads.
Right. I had a conversation a little over a week ago with a fairly decent sized carrier, 400 or 500 assets. And his locations were all in the area that you're highlighting there. He was in Omaha, St. Louis, Fort Wayne, Indiana. And a lot of his contracted routes took him from those locations to Texas or maybe to the Southwest. And he said that he was sending all of his trucks out to LA because he knew he could get something long haul and with a pretty decent rate. So if he sends his whole fleet there because it's easier for them to get back to its general area instead of taking a lower rate from Dallas and back, well, now that's like what we've been talking about. That truck is now going to be out on the road longer. If he gets out to LA, he might change his mind when he's out there as far as the load planner is concerned and say, maybe I don't send him back home. I can take 2 shorter haul routes, stay in the region, and my blended rate is higher. Now you have that capacity that was supposed to come back to that homeland or that home market 4 or 5 days from now. That isn't going to happen. So it's almost trying to work through this map and trying to work through all these metrics to determine what's the next shoe to drop. Because it might not be the market that's moving today, but it certainly can become the market that's moving tomorrow.
Yeah, absolutely. And moving markets, we've got about a little less than 10 minutes left. So I wanted to talk a little bit about, okay, we're seeing these volumes, and let me bring back this where we started, the very first slide or very first chart that we started on here real quick. As soon as it comes up here. So it's outbound tender volumes. It's a year over year, looking at the seasonality, right? Let me pull it up for a full year.
You know, seasonality, just very briefly, that was another reason I said, look alive, folks, it's going to get busy. We're in possibly 2 of the busiest weeks of the year on the calendar right now. So if we have this kind of disruption happening on the West Coast and we have any sort of a normal pre-4th of July holiday push, these last 2 weeks of June, maybe the first few days of July, could be extremely busy from a volume and rate standpoint.
And I would say that it's going to be.
Mm-hmm.
But here's the question that's on everybody's mind. You see, obviously, here's the effects of COVID, right? Of the shutdown, the preponomics, the pull forward, and then everything shuts down. But since then, everything has been acting. You can almost predict things by just looking at seasonality, right? And it's been acting that way. And so when you look at this area here, and if I scroll in a little bit closer, coming up into breaking 11.5 again is not going to be out of the question over the next week in my mind. Looking at this and what's going on here. Okay, so it's acting that way. But what's happening? Why is it this way? We don't have a stronger economy than we did in 2018.
You don't have to.
Unless I've been dreaming everything that's just happened for the last 3 months. We don't. Well, so what's going on?
So last year, we didn't have that strong of an economy all year long.
We did not. That's right.
You look at that. You look at your OTVI chart here, and you've got you see 2019 volumes eventually overtaking 2018 volumes. Everybody kind of lumps in 2018 as this one long, great big year of activity. Actually,
no. Fourth quarter, it's died.
Actually, it was halfway through 2017 into the first half of 2018 that it was so robust. But that being said, it took a while for people to, kind of adjust to that scenario. So, in their mind, the rates didn't come down as rapidly, as they potentially could have because they didn't have this background information, obviously. But at the same time, you're looking at this and you're saying, when you look at some of the patterns intra-market, for instance, we're seeing like those regional movements start to increase in relation to the longer haul movements. We saw this exact same impact last year at the early part of the year. The first half of 2019 was propped up by a lot of this shipper supply chain repositioning, if you will, like where they had warehouse to warehouse movements. And and the way you figure that out is you look at some of these larger markets, and see their length of hauls. And as they're getting longer haul off the West Coast, out of the port cities, out of the border cities, that's an indication that we're seeing warehouse repositioning. The shorter haul freight, the regional freight, is more that final end point, into store, into final user, but it also is an indication of what we saw last year, which was simply this warehouse is full, I'm going to go down the street and go to the next facility.
Yeah, or moving LA volumes from LA to Stockton,
Yes.
Allentown, Pennsylvania to Harrisburg.
Right, exactly.
That type of stuff. And I've switched charts on you while you were talking here because you kind of moved into what we were talking about, right? So we're going there, and this is what you're talking about. Long haul right here, leading the charge, is now flat. Long haul has been flat. Your tweener has been flat for a while. Your local, right, or city has been flat. What's driving it here is short haul and mid haul.
Yeah, your 250 to 450 mile, or your 100 mile to 450 mile loads, which again, traditionally your regional coverage, especially in the truckload space, it's regional distributions.
Yeah. So what you're talking about here is kind of this. If we saw short, mid, and local all carrying it, right? That would be more indicative of things going to final destination, to consumer, to reset.
It's exactly what you saw back there in March.
Which you saw, which we saw back. We saw it back. Yeah, well, let's move it over. Yeah. Right here. Everything moving in tandem.
Mm-hmm. But you also saw you saw a lot of that short haul volume. If you look at the
well, wait, right here, you saw long haul. Oops, sorry. Let me move this over a little bit more. Long haul flat, but you saw everything else and local. Just
you saw local. You saw short haul.
The warehousing restock, right? We need to get the goods back on the shelves, and then after that, the long haul kind of took over because in having some conversations anecdotally with shippers. And some of them got caught with their pants down. They didn't have the goods where they needed to be, so the long haul takes over. But now, what you guys are showing here, we're basically moving stuff warehouse to warehouse. And I think inferring from and reading between the lines from what I hear from shippers, a lot of it is just anticipation. They don't want that to happen again as far as not having the goods there when customers want them. So maybe at the final end, consumer demand isn't quite there. But this overheated freight volume right now is just in anticipation of that. Obviously, again, the question we're all trying to figure out is, does this come to fruition?
Yeah, and I think the idea that the service levels are just not there anymore because capacity's been reduced on things coming into the country. A lot of these shippers are basically saying, "I've got to be ready when the economy is."
That's exactly right. But because now you start looking about and exactly what we're talking about, and further proof to that or evidence or other data points to look at. Let's see. Let me pull up something here real quick. Unemployment was 1.5 million, which was a good week because new claims 1.5 million was a good week. Let that sink in for a second.
In recent history.
20.5 million continuing claims was a good week. Let that sink in for a second, right?
I'm going to throw out a really, really crazy screwball out of left field idea for how this can sustain itself. Obviously, there's a lot of numbers and economic data that says things are terrible, and they are. So everyone is kind of expecting this freight volume bubble to burst. But think about it in this approach. Obviously, unemployment is sky high, and there are a lot of people that have been laid off. But they have so far tended to be the lower paid with respect to an entire business, the lower paying jobs. So those that are remaining employed and those that are still earning that paycheck are the ones with a higher level of disposable income. And given that we still see restaurants, vacations, those kinds of things extremely subdued, that disposable income can now be allocated for things like home improvement or redoing the interior of the house, whether that's purchasing new furniture or any sort of goods on the inside. There is that possibility that those dollars that were spent on going out to eat or going to bars or going on vacation now are focused on buying things for the house or just for someone in general. If that's the case, seeing that almost all of our stuff is produced overseas and has to come over here, there's a very good chance that we could see these volumes remain elevated. And it sounds obviously very crazy to think of it, but the scenario that we're in right now in the situation, it isn't the craziest idea that we could see a large amount of goods continue to flow through this country while we're in this semi-lockdown, semi-quarantine stage.
Yeah, it's a solid point. And what it comes down to, really, Zach, and I'll let you have a word here, is will consumer sentiment and everything sustain itself until we get this engine cranking, right?
Yeah, the consumer is what drives this economy. We've done it for a long time now without the industrial production numbers. Obviously, we'd like to have the industrial economy kick back on, but that has yet to be seen. And to Kyle's point, this is not the same unemployment rate that we saw in 2008, 2009. It does not mean the exact same thing.
No, it absolutely doesn't mean the same thing. Hey, we've got about 15 seconds left. So, Kyle Lintner, how do people get in touch with you, learn more about what you're doing there in K-Ratio real quick?
The easiest way is probably check us out on the web, k-ratio.com.
Excellent, excellent. So thank you so much, Kyle. I'm sure we'll be back on again talking about this. This was a great conversation, and hopefully we'll be talking about how it is sustained and just going through the roof. So, Zach, thank you very much. Kyle, thank you very much. Everybody else, thank you for tuning in. Freight Forecasting every Thursday, 4 p.m. Eastern Time. I'm Michael Vincent. Peace and love. Have a great week.